you can charge people a lot more money than you could before for labor automation. Typically charge 5x more than you could before. $1 million kind of top line benchmark from the past. I think that's a seed benchmark now, not a Series A benchmark.
Why is vertical labor markets the best place to build and invest over the next decade?
I think we're 1 year into a 5-year transformation. We've seen many businesses of ours layer on business lines 2 and 3 and 4 very, very quickly. And so we've seen founders of ours build, a 5 business line business in 5 months. Nearly everything else offline labor-wise is automatable.
Why the first year and how did you come across kind of that metric?
So I don't think...
Hey everyone, welcome to Climb. I'm so happy to have Samit Kalra from 1984 Ventures. He's a partner in a $70 million pre-seed and seed fund, backing founders that are modernizing legacy industries through vertical AI, digital health, and infrastructure software. Formerly at Bain Capital Ventures and AngelList, he's led early-stage investments in breakout B2B companies and vertical AI leaders like Alex, Rev, and many more. Known for his execution beats theory approach, over 75% of their portfolio companies have advanced to Series A. So I'm excited to talk to him about what it takes to get to a Series A today and what kind of founders he looks to back that are able to build category-defining companies. Samit, thank you so much for joining me on the show.
Glad to be here.
Awesome, man. Well, you and I share a passion for vertical SaaS, vertical AI, labor automation. So why don't we kind of start our conversation there? Make the case, why is vertical labor markets the best place to build and invest over the next decade?
So there's a few reasons. One is it often lacks a clear software player. So you're not going to come up against them with a strong kind of existing distribution play. I think that's a really important starting point. 2 is you can charge people a lot more money than you could before for labor automation. So you can turn a sector that was unprofitable to sell software into something that you can now, typically charge 5x more than you could before. And I think labor automation counts as a deep pain point. And so that's what we look for as founders and early stage VCs is find a deep problem to solve. Automating somebody's job, to put it kind of crudely, is a deep pain point. So those are the main reasons that we're...
Are there certain niches that you feel like better fit that paradigm where there is labor or service that you can automate, and how do you identify those?
I think right now, if I were to generalize, AI can read and write and speak and see and listen. And so if you think about those skill sets, there are many tasks that are well suited to it right now. I think many people's jobs involve these kind of repetitious workflows. I think they're often pretty well within the AI bullseye even right now. Probably what's not within the bullseye is a job which, even though it can be automated, has some kind of trust or stamp of trust that comes with it. For example, tax services, advisory services, where you're not just buying the actual work, you're also buying the peace of mind that this passes a certain quality threshold. So I'd say those industries I'm a little bit more skeptical of right now. Nearly everything else offline labor wise is automatable.
Can we double click on that trust piece? Because that's actually very, very fascinating. I haven't thought about it like that. What would have to change for people to start trusting a GPT wrapper? I mean that a little bit pejoratively, but what would have to change for people to start trusting AI to do some of those high trust jobs?
I don't think that happens quickly, even if the task is automatable.
Okay.
I think the expectation is that if, humans can be wrong providing advisory services, but it doesn't mean that we're going to stop working with that firm. So like KPMG can make a large mistake, but KPMG is still going to stick around. I think if a fully AI KPMG makes a large mistake, the expectation is that there could be many more mistakes that they're also making. And so I think it's going to take many more years of just getting comfortable with the fact that AI can do those tasks. Yeah, it's not something I'm totally sure about when that timeline would change. I would suspect it's more than 5 years out.
One of the things I enjoyed as I was getting to know you was reading your blog, and you've talked about this idea of focus on revenue lifts, not cost cuts.
Yep.
So why is that, and where have you seen that play out in your portfolio?
Yeah, I think this was our key learning of the last few years, is that AI can make businesses more money, can also massively save them costs. I would say we care about those two value propositions more than we care about time saving.
Okay.
And so maybe 5 years back, SaaS was getting a little bit long in the tooth, where you're like just not finding that many interesting ideas anymore. And people were like saving time or some kind of workflow improvement. I think that's just not a high enough bar anymore, because AI can do things that are just so much better than the way they were done before. And in many cases, that is making more money, and that opens up many sectors. In other cases, that's kind of slashing jobs, and that brings down costs. So it's a top line improvement or a bottom line increase as well. So I think both those things good enough for us to get interested. If someone's saying, hey, I can just make this workflow like a little bit faster, we're less pumped about it.
So on that note, I was at a talk yesterday with Kevin from OpenAI, and he said something along those lines of, if you're scared of our next model release because you feel like, we're only 30% accurate, like I promise you we will get to 90% accurate in the next model.
Yeah.
If you are excited about our new model release, then it's probably a good place to invest, right? How do you think about the underlying models and their improvements when you look at that lens of revenue lift and cost cut?
It's a very good question, honestly. And I think one of the key learnings over the last year is that it's also easy come, easy go. So you've grown really fast doing this one thing, you're making the business more money, but if it works so well for you, it's going to work well for other folks as well. So you're going to have a lot of competition for every idea, and you better move beyond that first thing into doing many more things very soon. I think it's very likely that the models keep improving, and you should expect that to happen. It's very hard to be beneficiary of that, I would say. So the way to think about long-term stickiness would be to do hard things outside of the AI. So like nearly what we care about now is like AI is very flashy, it works really well. What are you doing that's not AI that increases the chance that you will be a long-term sticky business?
The old Paul Graham, do things that don't scale, right?
I think it's just do hard things over and over again that others would also have to do to actually, to
catch you.
Exactly.
Catch you. Yeah. On that note of expanding out to multiple products.
Yeah.
You've written about this as well, and this kind of reflection that to survive in AI, vertical AI today, you have to get multi-product within the first year.
Yeah.
Why the first year, and how did you come across kind of that metric?
It's an insight that we've had just based on observing our own businesses that we've backed, which is that everybody's really obsessed with revenue growth. But I think we're 1 year into a 5-year transformation. And so if you really over-focus on that first year's growth and say, this business went 0 to 5 this year, it's going to go 5 to 50 next year. I think it's a very foolish optimism in that we've seen a bunch of competition pop up for every good idea. And so just because you didn't have any rivals this year is not going to be the case next year. Mm-hmm. And so one way to offset that is to think, what's a value proposition that customers would choose you for over other players? Multi-product all-in-one is a very good pitch. And especially if that first business line is going to become like commoditized, and that's not just with other players, that's like incumbents are also going to go after you. Mm-hmm. So we've seen many businesses of ours layer on business lines 2 and 3 and 4 very, very quickly. Also, the vibe coding tools have made it such that you can do that now. And so we've seen founders of ours build, a 5 business line business in 5 months.
Well, give me an example from your portfolio where that worked out. And I'd love to hear one where it was maybe a little bit harder to expand to a second product.
It's early days. We backed a company a few months ago that is in the rippling for offline worker space.
Yep.
It's called SIRA, SIRA. And it's a 2-person team, and they have built product that comprises scheduling, time tracking, I think payroll, and a bunch of others. And this is a 2-person team. And those are pretty hard business lines to build. It's just something that we didn't expect somebody could do until we saw it. And now they're able to go and pitch a bunch of these offline customers and say, why would you not use us? Let's just have an all-in-one tool. It's underpriced relative to those 5 things that you were otherwise paying for. Many of those tools sucked. This is a very new, a very slick all-in-one offering. And so that's been a very eye-opening example for us. I would say we have companies that fell victim to the idea that like revenue growth was going so well. We have this one thing that we found before others did. And in most cases, we've seen incumbents offer something similar or other companies come into that space. And so the margin compression is very real. So I think these are lessons that we've learned from experience, and like the world is moving so quickly right now that these lessons have been learned the last few months. I think they were even last year we didn't know that this was the way way that businesses kind of had to be built, I would say. So
yeah. You brought up this topic of offline workers, right? So again, we shared this passion around labor automation for what I call dirty, dusty, and dangerous industries. I'm sure you guys have your own terminology around it. When have you found those businesses to be good venture backable businesses versus maybe more positioned for like a private equity scale or roll up?
It's funny question. We just had a couple of companies of ours get bought out post-seed by incumbents for, pretty sizable dollars. Founders who've only sold 20% of their business away have walked away with lots of money. And so there's a lot of appetite from incumbents to buy upstarts that are AI first or possibly going to threaten them long term. That's not the goal when we make an investment to see that happen that early on, but it is happening right now. I think it's probably a trend for the next 3 years. What makes an offline business, I'd say venture scale, would be if you can really tap into the labor automation idea, you can really increase ACVs that turns a sector that was otherwise didn't have much budget for like tooling and software into something that is now substantially bigger. And so, it's not a difficult kind of calculation to do. You can say, if something that used to charge 5K, you can now charge 50K for, that's a 10x bigger market. I think everybody has figured this out, that like most markets, if you focus on labor size venture scale, which is why you see investors backing companies in sectors that you would never have backed even 3 years ago.
What's an example?
Debt collections, selling software to debt collections agencies, whereas now you can actually do that job of a human. Many call center focused businesses, there's many call center like businesses out there. That's been an example. We backed a company in recruiting that automates interviews.
Okay.
Surprisingly, candidates love being interviewed by it.
Really? By AI?
By AI. They feel that it's a safer interviewer. They feel like they're actually better heard. In many cases now, there's thousands of applications for every job as well. So companies overwhelmed with the number of applicants. And so companies are actually happy to use this for a first screen. That's a very unexpected market, but like suddenly you can tap into the labor piece there, and it really increases the dollars you can charge. We did one in pest control.
Okay.
Yeah.
How does that one work?
System of record opportunity within pest control. Obviously ServiceTitan IPO'd last year. It's a $10-ish billion company, focuses on large enterprise home services businesses.
Yep.
The smaller home services businesses were typically, 5-person team. They're not going to buy software. But the pitch for a business that we back was, we're going to automate every call for you. So 24/7 call answering. Maybe you're out there on the road working. You just missed that inbound call, but it's a very high intent lead.
Yeah.
So let's make sure that we don't miss that call. Cool, we can do that for you now. Hey, what about we also do like dispatching for you?
Yeah.
What about we help do like sales coaching for your reps? Like maybe they should have said this and upsold the customer.
Could I push back on that example because by the way, I've done very, very similar businesses for electricians.
Yeah.
And you've done one for pest control.
Yeah.
And as you're describing it, I go, these businesses sound remarkably alike.
Yeah.
And yet they are being built for specific verticals.
Yeah.
How much does vertical specific knowledge and vertical specific data matter? Or, is this all just going to end up being rolled up or subsumed into one horizontal AI play?
It's funny. So in this example, ServiceTitan actually has a pest control system of record that they've bought, and it sucks.
Okay.
All pest control companies hate using it. And so I think it's easy to assume that the big, large player adds AI. In many cases, if it's easy, they will do it. But many industries are actually much more nuanced once you look under the hood. For example, pest control is reoccurring usage, whereas, landscaping might be more like one-off. And so that has a big impact on the dispatch routes.
Yeah.
And that's a very, very different algorithm, for example. So there's like these little nuances that you would never otherwise have known other than going deep. And I think that's my view, having been an investor for 5+ years now, is that everything is much more complicated once you get into it. And so why does one company do well over others in a space when the offering looks pretty similar? It's like founders' execution skills, and that's better solving people's needs, and that's going deeper, and that's making people happier. So candidly, I'm not as worried about it. I think there is a ton of competition for every business idea, which is a different market than we've ever been in before, which is, anything that you found that works, others are also going to find. But the prizes may also be larger, and there are many more industries in which you can build businesses now too.
Yeah, it's probably why that founder market fit aspect, I mean, it matters a lot to us. I would say if I was, stack ranking it, it's probably like 60% of our evaluation is the founder and their founder market fit and their kind of earned secrets, I would say, just given how early we invest, right? We talked about before we hopped on the mic, like you can make the mistake of over-indexing on product and less on the founder market fit. I don't know how you think about your evaluation ranking of a founder, what's kind of, highest priority in the stack and what's probably the least priority.
Yeah, it's a question I've thought so much about over the 5 years of being a seed VC. Like what is the framework of how to make an investment? And I just listed things out for many years. And what I've come back to 5 years in is the founder brilliant in some way? Does that also link back to the business that they're building? Have they found a deep enough pain point? And can they ship software fast? And many other things you have to answer to, but like mostly they fall underneath those three. And so I would say that we have found that domain expertise is not essential. Many people can get up to speed on a space relatively quickly. So that can be months. That's not like, I worked in this industry for 5 years. I think the software skill set really matters because often engineers can see solutions to problems that others can't when they hear about it. And cool, maybe I can solve it in this way. And so we've really backed engineering first team. So there must be someone technical on the founding team. And then we've always indexed on hair on fire problem. So if it's not a deep enough pain point, we're not interested. And I think there's a lot of people that get really enamored by the tech. I think we're probably more problem first.
Yeah.
What else is there to say about what we've seen work? I think we've seen a lot of companies pivot as well. So that's also why we've become less fixated on what are they initially working on, what exactly is this thing that they're doing right now, because we assume that the smart founders will not rest until they find a deep enough problem to solve.
Yeah.
And that can be a close pivot or it can be a hard pivot as well.
That is a hot take, by the way. I appreciate that because most folk you talk to at pre-seed and seed, I feel like talk about this founder market fit. And so to hear you say, actually, you can get up to speed on an industry, I'm curious how that ties back to your earlier statement of most industries are more complex than people give it credit for. Can a founder who doesn't have domain expertise find those, unique, hairy problems that you might need years in a business to figure out?
Candidly, it's a super interesting thing to say because I think the main thing people lack right now is insights. And I think a few years ago when there were less business ideas, it was easy as an investor to filter founders based on who has a true insight about a problem. Like, why is what you're saying true? And obviously the world exists the way it does for a reason. So you can't just, even if things look silly, they are that way for a certain reason. Businesses also. And so we would kind of wait until someone said something that like made us sit up. Okay, that's an unexpected insight about a space. Sometimes that comes from someone that knows the space really deeply. Sometimes it comes from a smart person who has started to kind of poke around and say, why does that work that way? And just keep asking why. And so that also works. I think right now, there are many more young founders. Many of them have less insights and many of them have, maybe you need less of an insight these days because there's so many hair on fire problems to solve. You can just, so many tasks to be rethought using AI. But if you don't have an insight, I think the chances of you really finding a true issue to solve is probably lower.
I like that a lot. And you're touching on the theme of this season, which is what is AI changing about how founders build? And I like this idea of you're looking to find the unique insight and the hair on fire problem. I'll close kind of this section on, do you think VCs in this new era over-index on market size? Is that something, because we didn't talk about that yet, how does that factor into your evaluation? Beyond it being a hair on fire problem, how much does market size matter?
Yeah, obviously you need your companies to be funded by follow-on investors. So it can't be the case that you think something is big enough and everybody else doesn't. You can't have that mismatch last for too long. I think many markets, as I was saying earlier, are expanding market size now by tapping into labor budgets. And so that is a game changer for many, many spaces. Many offline industries that you otherwise wouldn't have invested in are now suddenly big enough. And so I think most investors are being relatively smart about, hey, that was too small for, but now that's interesting. Let me think about the underlying labor play there. But yeah, I think the true observation as an investor over the last few years is that it's so easy to to over focus on the first thing that people are doing. Typically, if you do a first thing really well, that same user offers up other problems for you to solve. And so we've seen companies of ours expand into so many unexpected adjacent spaces that we couldn't have foreseen when we invested, but it was about the founders' ambition and search for bigger and better things solved next. So the reason we don't focus on it too much is because we think that best founders keep finding more and more things around it. Obviously, if the space is so small, then even spaces around that initial circle might not be big enough. So there is a nuance to it, but I think in most cases, the headline number of the existing software size is misleading.
Yeah. How clearly do you feel a founder has to articulate that expansion strategy, the 2.0, the 3.0, at the time you're making the investment versus you feeling like there's enough space to grow?
I think at the pre-seed stage, we don't mind if they haven't thought about it as yet. At the seed stage, if you're raising that $6 million round these days, that most seed investors are now behaving a little bit like Series A investors. So they expect that a bit more. So if you can't explain why it's big enough at that stage and you're raising that kind of round, I think you probably won't raise that round. If you're raising a $2 million seed round, you can probably get away with it as well. You certainly do have to be able to tell that story definitely by Series A, but I think seed is the new Series A in some respects, so you probably have to think about it by seed as well, but it's very hard to know it at the outset as well. So there's some leeway given to founders as they're getting going or early.
You dovetailed beautifully into my next topic, which is what is a seed anymore? And this idea of seeds are really Series A's and Series A's are really Series B's.
Yeah.
For somebody, like yourself, like myself, that's been doing this long enough, we've seen everything kind of shift to the right a little bit.
Yep.
When do you advise a founder to go raise a Series A versus go raise some version of a jumbo seed?
I think the answer, if I were to draw some kind of blanket rule, would be very hard to raise a Series A right now. And you don't get any credit for things that you say that you're going to do that you haven't done as yet. Obviously, there's a lot of flashy companies that go out and raise A's. I think those headlines are pretty misleading for most founders. That's just a very, very small sliver of companies going out to raise A's. So the $1 million kind of top line benchmark from the past, I think that's a seed benchmark now, not a Series A benchmark. And so you're probably going to aim for 2+ to raise
ARR, contractual. I mean, what do you think about it as a...
Yeah, I think investors are being a little bit loosey-goosey right now with what revenue means. For us, it's just like a high margin, low churn. It can be usage-based these days as well. So it's not just recurring revenue per se, but it's good revenue.
Yeah. And how do those margins compare? I mean, I'd love to get some concrete numbers if you don't mind. Like, how does that margin in an AI world compare to the old world of 70-80% SaaS margins?
Yeah, it's certainly lower in many cases, and it's case by case based on how much you're pinging the underlying model as part of your core SaaS offering. So we've seen it go down to 60% or so. I think some investors are more willing to overlook that right now if the company is growing explosively with word of mouth, because then your sales and marketing cost goes down. So you can think about it as like, hey, one's down, but one's up. It's fine. So yeah, I think that number can go down based on the underlying business that you're building. I think this negative gross margin or zero gross margin thing is super risky. But I'll leave that for others to...
No, I mean, explain that a little bit if you don't mind. What do you mean by the negative gross margin, zero gross margin business?
Some people are claiming pass-through inference as their own revenue. And so they're just reselling inference. And in those cases, the margins are super slim.
Single digits.
Single digits, yeah. But they may have $0 spent on sales and marketing as well. So you do have to think of them as a group now, I would say. That's a different way of thinking versus just gross margin. I would say operating margin is probably the way to think about things now. But if your gross margin is 0 or less than 0, then you're in trouble unless something changes.
Yeah. You mentioned the fact that it's gotten harder than ever to raise a Series A. Given that some of the companies in your portfolio have had success raising Series A, what makes an exceptionally well-run Series A process? Timelines, structure, what the founder is doing day one to day whenever they close.
I would say first thing is, practically speaking, don't just pitch a handful of firms. I would expect from our experience, you have to pitch 30 to 40 firms to make sure you can get that one term sheet, if not more. And so some founders are like, there's 10 firms that I really like that I'm just going to pitch them. I think you have very low chances of pulling that off. So first thing is, give yourself the best shot by pitching the right number of firms, dedicating time towards that, so that this is going to be like a full-time job for the CEO for nearly 2 months, I would say. The other trick, it's not really a trick, but is to find the people that actually like what you're doing. In most cases, it's impossible to convince someone that is skeptical about your space or is not extremely enthusiastic about learning about that space very quickly. Typically, it works best when someone's like, yes, I've been waiting for this company, And so do your research to find the right person that's been talking about a space that said, suddenly this industry really interests me now. And so go and make sure you find those folks. That's going to increase your chance of raising. The third thing, like I said earlier, was you're currently not getting any credit for things you haven't done as yet that you say that you're going to do. So if you do business X and you say, I'm going to actually launch business Y next month, people will say, well, come back to me once you've launched business Y. So they're always looking for holes to nitpick, because there are so many companies raising and they can just not invest in those ones because there's something growing faster.
Yep.
It's probably 5 companies that they met that week that are growing faster than your business. So they're just being pickier. And so only go out when you have the best story, the best recent business traction. I would say those things really help. Yeah, so I think that's it's not too dissimilar for how things used to be done, but it's certainly a higher and kind of crisper bar that you have to meet. So don't take the risk unless you have to.
You mentioned the time frame around this 2 months, which is, I think, really, really interesting and not a topic that gets discussed a lot. If a fundraising process for a founder lasts longer than 2 months, did they do something wrong? Was it not set up correctly? It's like a sales cycle. I think about, if you're selling enterprise software, how do you bring the sales cycle down, or how do you bring the fundraising cycle down and ensure that you don't have a fundraise that lasts longer than 2 months?
Yeah, look, I think it's hard to, if somebody is dragging their feet, they're likely not going to invest. I think that's something that you learn in sales, something that founders also learn when they raise. The best way to give yourself this chance of having multiple people excited at the same time is literally to pitch people at the same time. So to have a week or two of just back-to-back meetings, every first meeting happens at the same point in time, would be the best way to give yourself the shot to build that kind of FOMO and to get a chance that, you can investors hate the idea of losing to somebody else. So once they learn that something that they're medium interested in might get snatched from them, they're likely to, put in more effort to double down and see if they also want to invest or bow out. And that's also helped to founders to say that actually I'm not interested in, versus being strung along. And so I would say most founders get this wrong of I'll do my first 3 meetings this week, I'll do my next 5 new ones next week. And it's very hard to get competitive bidding pressure when you don't jam people into the same time boxed first meeting period, I would say.
How do you keep people in the same phase, right? Everybody's moving a different, time frame. Somebody might have another deal that maybe they're on the tail end of as they're meeting you. Are there tricks that you've seen your founders employ to kind of keep everybody in the same time range so that you can get that competitive bidding pressure?
It's really hard to know if an investor is working on a different deal at the same time. It is happening a lot these days. Investors are really busy with deal flow, and it is a shame when you're like, this investor would have loved this company. They're just busy with something else. I don't know if I have a good answer for how you can foresee that happening. Certainly keeping investors that like your space apprised of the business going into the fundraise can be something that can help. Just, by the way, we plan to raise in X month's time, or just small pieces of news about your business. Hey, last time we spoke, I was talking about closing, customer X. That's actually happened since then. Things like that of just building trust over a period of time can be helpful. So I don't think coffee chats with investors, a small number of investors in advance, is a big issue. I think founders should probably do it, but they should recognize recognize that no casual coffee chat is actually casual.
Yeah.
Everybody's writing down notes when they meet you of like, hey, you said you were at 1 million of revenue last month and you're still at 1 million this month. Okay, like, you didn't grow in that month, versus like, you can actually, I think as a founder, time those chats to share good news about the business. And so I think founders should probably be a bit more tactical about taking those coffee meetings and when they do it. I think some founders do this thing of like, I'm just so busy right now, I'm just not going to do it. Like, you're like, well, just think about it. Maybe that person is showing interest. They've followed up a few times about your space. Figure out when could be a good time to get them up to speed on your business, get them pumped about it. And then when you go back in a few months' time, you have more things to share that can build upon that story.
Yeah. I'll give you a hot take if you want about how I've helped some founders tighten up that thing. I'm going to piss a lot of Series A investors off, so if you're watching, sorry. I tell my founders never to send a data room. Never send a Dropbox link with 30 documents in it. It is the fastest way to get a Series A investor to backburner you. Because now they've got all the information, right? Like, I think about a fundraising process as trading information for engagement. And if they're not engaging, what do I have? I've already given you every document. So what I tell founders sometimes is, hey, your last chat, what was it about? Oh, they're really digging in on sales and customer pipeline. Cool. Send your sales deck, send customer pipeline, send testimonials, and then schedule a call 48 hours later where you say, cool, let me talk you through pipeline. And to me, I think that's been a really good way to just signal who's interested and who's not. If they take that 48 hours and they go, yeah, okay, that means they're probably working on your deal as priority one. And if they're like, oh man, let's chat Monday, let's chat Tuesday. I've had founders go, hey, that's totally fine. We've got 4 other investors that I'm having these chats with this week. So if you can make the time, I'd love to have it with you. If not, we can wait till Monday, but just know that you're going to be a little bit behind in the process. And like, it's a little bit of gamesmanship. I agree. And that's why I think it annoys Series A investors, because they're just like, send me the link, man. But I've had founders push back, and I've seen them push back successfully. Where they've gone to the A investor and say, no, listen, we're not sending a full data room. Tell me exactly what you want. I'm happy to send it to you, and let's have a call to go through it. So I don't know. Try it out.
I think fundraising narrative matters so much, and when you send over a bunch of information, you seed that kind of story that you're trying to tell. And so often, if you send across a lot of data, people analyze that information and they say, hey, that churn number is actually higher than I thought. You start to get into those questions not on your own terms. And so really making sure how you share information does matter a lot. It is storytelling, and it is getting people to get kind of greedy about your business rather than fearful.
And if you're on the call with them, you're able to put that number in context. Whereas if they just look at it, they're putting it at their own context of the 5 other businesses they're looking at.
Low NDR number relative to what I'm used to seeing. That scares me. And actually, there's a bunch of context behind it, but you didn't get a chance to explain it.
Exactly. What do you wish more founders would stop doing when they're pitching you? Now we're kind of coming back from Series A to seed. What do you wish founders would stop doing when they're pitching you?
I think this is, maybe I'm just not smart enough, but it's very hard to get up to speed on a bunch of details very quickly. And so if somebody bombards you with a bunch of facts, it's difficult to comprehend all those facts, especially if it's a space you slightly know or don't know very well. I think many founders over-rotate on dumping information on your plate without kind of culling and only saying what's important. So I think the purpose of a first meeting is to get the next meeting. And many founders, I think, just never think that way, which is, is this person, did I get that person interested enough to learn more about my space? They're not going to learn everything on that first call. And so I think many founders just focus on information sharing and don't craft just the key facts that are worth. Think about any interesting meeting that you have. It's typically 1 or 2 things that you walk out of that meeting and say, that fact was really unexpected. Let me go and learn about whether that fact is true or not. And I'm just going to go and see if that thing is real. If you have 10 things that you heard, it's kind of hard to know which was the most valuable. And so I think, imagine the investor has 5 meetings like that every day. 25 meetings. That's a lot of meetings a week. But let's say most investors probably do 15 founder meetings a week.
It's fair.
Which is a lot. So you have to stand out amongst those other 14 meetings. And so don't scare them off preemptively.
I like when founders lead with a narrative disruption. Where they go, I'll give you one example from our portfolio. Hey, you think selling into law enforcement is a super long sales cycle. We've gone from sell to onboarding in 30 days. You're like, okay. If that's all I know, if that's the only thing I remember about you after that call, I bet you I'll be thinking about it the next couple of days. And I go, what have they figured out? Yeah, exactly. What have they figured out that nobody else has about this category? And sure enough, enough, that was exactly what the founder did when I backed them 18 months ago, and continued when they raised their Series A now. Exactly the thing that the Series A investor called me and they were like, is this real or is this bullshit?
Yeah.
And you're like, no, actually it's real.
Yeah.
And that's kind of what catalyzed the Series A conversations. So I think that narrative disruption is actually a very, very cool way to be memorable as a founder.
Yeah, and I think the good storytellers tend to do that. They know not to overshare, and they know what to say that piques interest, and they're kind of like stand-up comedians. They test lines, they see how the people kind of resonated with it, and then they either keep it or they discard it.
Yeah, love that analogy. Coming to specifically vertical AI businesses, how do you think category defining companies in vertical AI are going to change? And how do you think founders need to change the way they position their path to get there in this new era?
I think it's find a wedge that is super valuable, quickly become multi-product, aim to become the system of record, play strategically with the existing underlying system of record as well, because often you're kind of leeching off of them for the first little while, but soon enough they're going to also catch on to what you're doing, and so you need to be pretty thoughtful about that. So I think it's a higher bar for founders to win these days, because you have to get more things right. You probably also have to be faster builder, a better fundraiser, a good forward thinker. It's a really high bar and an ambitious product roadmap as well. So I think it's actually quite clarifying from the early stage investor lens of like, hey, this is what you have to do now. And certain people demonstrate that they have the skills and mindset to pull it off. And I think others who are less fixated on being able to put the ship together and sail it very quickly are unlikely to become the new age vertical SaaS winners.
How much of that can be learned? You do pre-seed and additional seed. How much of that can be learned? How much of that has to come, batteries included?
Yeah, look, I think my observation from investing over the years is that there are impressive people that learn skills in a very short period of time. They're pretty rare, for an engineering founder to then go and learn sales. Pretty rare. I don't think people learn how to become better fundraisers in 1 year's time between seed and A. I don't think you can go from being a bad storyteller to a great one that quickly. And so you don't want to be backing founders that you have to shine up to the market too much. You'd rather back someone that is great that others haven't met us yet. I think that's probably the more practical approach to early stage investing, because the time to that next, the time to raise that next round can be very fast now, especially if you are growing explosively out of the gate. But yeah, that's typically why we back people with some kind of brilliance, I would say, because that shines through when other investors meet them as well. So they can be a brilliant salesperson, they can be a brilliant marketer, they can just be the most intense person that you've met. They can be the most ambitious person in that space that you've met, who's not gonna stop at doing that first thing, is gonna build many more things from there.
Yeah.
So I think that skill set of something great that helps the business is probably the way to de-risk early stage investing, because that at least if things do work, that person has something that they can hang their hat on. But yeah, I think I've seen many founders grow, I've seen many founders not grow, and it's been somewhat hard to forecast going into that round. But I think less brilliant people are typically less likely to grow as well. So just because you are brilliant doesn't mean that you will grow, but you probably have a better shot of growing because you've demonstrated growth in the past.
Yeah, that's fair. We talked about how hard Series A is today. If you look a year out, we're having this conversation end of 2026. What would have to change in the market or with the founders for that Series A to flip? Or is it just going to get harder and harder? Are the metrics just going to get higher and higher for a Series A to get done?
I don't know when it's going to flip. I think it will flip at some point. I think it's too restrictive right now. I think there are many good companies that are not meeting the Series A bar, but they have product market fit. They have something working. And that's kind of why this jumbo seed class has come about. Funds that used to do seed investing are now like, I can do a deal at $1 million of run rate revenue, and I can get a lot of signal out of that. And like, if it's B2B, you can talk to a bunch of customers. You can make up your own mind about whether that thing works and makes sense.
And what's the right pricing for that, right? Because if we're talking about $6 million as a true, or jumbo seed, how do you think about dilution and pricing?
In many cases, 20% dilution makes sense. So, but these a 5 on 25 round can become 6 on 30 or 7 on 35. Blink of an eye if you get multiple funds bidding for you, and it's the same dilution for the founders. For a multi-stage fund, it's essentially the same size check in their minds. 4, 5, 6, 7, 8 million. These are all the same number, more or less, which is funny to say. So yeah, look, I think the Series A bar has gotten too high, too restrictive. There's an over rotation on top line growth right now. But I think the reason that will change is because it's kind of like happy eyes right now. Everyone's like, oh, that company's growing so fast. They're just going to keep growing that fast. And I think that's just not going to be true 2 years time. But look, there's a lot of really big funds out there these days. So they're not running out of money anytime soon. I think there are many good companies that are not yet getting the eyes of Series A investors that are totally worthy companies. And those companies just need to keep doing what they're doing, be able to raise enough money to get by. At some point, the business does start to speak for itself. You know? If you get to $5 million of revenues, $10 million, these are really impressive numbers if the quality of revenue is also high. And so I have quiet hope for a lot of these like quiet compounders.
Yeah.
We call them, yeah.
This has been so fun, Samit. I'd love to close with you where I like to close with all our guests this season. From everything that we've talked about, if we look a year ahead, what are you most confident will still be true? And what are you least confident will still be true?
I think I'm most confident that the way to build a long-term sticky business is to be doing a bunch of unsexy non-AI things that are hard for others to also replicate. That could be like integrations that are really, really painful. That could be proprietary partnerships. That could be curating a offline network that if someone else has to also go and do that. So I think all these pre-AI ways in which you would build defensibility are going to come back into vogue. And so I think the folks that are actually doing that and also leveraging AI with the core of their business are really well placed. What do I think I'm less confident on? Maybe it's an open question about whether revenue growth expectations, whether I'm being too pessimistic about those companies being able to keep up those revenue paths.
Yeah.
And so I think I'm just seeing early signs that if something works so well for you, others are going to catch on and do the exact same thing. That's how the free market works. Incumbents and startups are coming after you. I've started to see it. I think others aren't talking about it very much, but maybe that doesn't happen in every space. And maybe the early king-made companies actually do go on to be the ones that win. I'm pretty skeptical if companies like sub $20 million of revenue that you can call them the guaranteed winner of the space. If they're at $100 million of revenue, maybe it's a different story. But like there's many spaces where like the A and the B and the C happen in the space of 6 months and you're like the company's at $5 million of revenue and you're like VCs love the thought of king making, but I don't believe you can king make that early, but I might be wrong. There's a lot of smart people in the industry.
Well, I am excited to have you back in a year and we can
explore
everything that may have gone right and wrong. Samit Kalra, I'm so happy that you joined me on Climb today. Thank you very much.
Thanks for having me. Appreciate it.
Awesome.